All right, good morning. Today is February 1st, 2023, and I'm back with another edition of the live show on a big day. And as I'm sure you're aware, today is Fed Day. And that's always a huge big deal, and especially this time around. I think it's a bigger deal than it has been in a while. So, the Fed I guess last year, embarked on a series of rate hikes, aggressive rate hikes, I might add. And so today they're going to actually they've been hiking like 75 basis points. I can't remember on the last one. I lose track of this stuff. I guess I should have a graph up or something, but anyway, they've hiked pretty aggressively and with the idea that they need to conquer inflation. So it's kind of funny because um, all these rate hikes are going to filter through the economy, and they're already filtering through the economy. And so the big debate for some time now has been whether we're in a recession or headed for a recession, or whether we're going to get a soft landing or all this. And of course inflation has been coming down, but obviously it's the rate of inflation, which we've talked about before. But the thing of it is that when the rate of inflation picks up, everything starts getting more expensive, and companies are raising prices and all that kind of stuff. And then, um, so everything that we buy, and especially if you go to the grocery store, everything gets more expensive and more expensive, and it's tough for consumers, right? I mean, you've seen the stories, and inflation is probably one of the worst monetary phenomenons because basically you pay more money and you get less for your money, so your purchasing power goes down. Which, by the way, the purchasing power goes down basically consistently all the time since the day I was born, right? Like the price of everything has gone up. And so, anyway, long story short, today's Fed announcement is going to be interesting, especially since we've had this rally over the past, well, since the beginning of the year. We had a pretty exceptional rally in January, and the funny thing is that it seems like everyone's a lot more excited about this rally than. And when I look at the chart, I think to myself, well, yeah, sure. I mean, the market has rallied all the way back up to where it was, right? And over here, think about 4,000, right? I talked about these different levels. Obviously 3,900 was kind of a big level, and it managed to break above that. And 4,000, big round number, but 4,100 is 4,100 is a pretty big level too. Let me just draw. Got my drawing tools open here. There we go. You can see that 4,100 is sort of a huge resistance level. Especially it goes back to these highs in December. And of course we hit 4,100 just the other day, last week for the high. Had a little bit of a pullback. So let's see. Anyway, if you zoom in on this, yeah, you can see that we kind of rallied back up into overhead resistance. And the interesting thing about this level, and the interesting thing about where the market is overall, let me just extend this, see if I can extend it kind of in a straight line to the left. There we go. So the thing about where we are now is, as I'm sure you guys remember this, 2022 was a rough year for the market, and what kind of saved the day was that rebound in the fall there. Um, Oh, but what my point here was, this 4100 level goes back to like this sort of panic low, which is kind of interesting. And it goes back to this consolidation and this little pattern here. So that's a pretty big level. And the big question about today is, well, there's several questions about today. One is whether Powell is going to raise 25 or 50 basis points, and more importantly, what their plan is after that, right? Because obviously, I mean, they've raised interest rates, and everyone's trying to figure out what the terminal rate is, meaning the rate at which they're going to just quit raising interest rates, right? So they probably have, for some reason, last year I remember thinking to myself that the December rate hike was going to be the last one, and that's, there's a lot of people out there saying that they should have stopped, or they should stop right now. And so, but the thing of it is, the market itself, I mean, what the Fed has clearly stated is that, they're trying to dampen speculation, right? And they're trying to bring inflation down. See, here's the thing is, even though inflation has been trending down, they do not want it to reemerge, which is always a distinct possibility. And if that happens, then they're in big trouble because yeah. Anyway, so we'll just have to see what happens. But my guess is, well, I don't really have a guess, to be honest with you. I mean, everyone's guessing 25 or 50. Seems to me that they should, at this point, they should probably go with 50, and then, talk about maybe doing one more or whatever. But the whole irony of all this is that, inflation picked up and basically got sort of out of control last year. And now that inflation's starting to come down, it's not like the price of everything is declining, and for whatever reason, that's freaks them out. That scares them worse than inflation, I think, is deflation. The price is dropping. And so, which doesn't make any sense to me, because I would love to go to the grocery store and see the prices on stuff come down, but that's not how it works. When you get a inflationary cycle like this, the price of everything goes up, and then when the rate of inflation comes back down, everything still stays expensive, right? So it's kind of that's why, back in the old days, they would say, you're not supposed to let the inflation genie out of the bottle. Anyway, a lot going on here with this chart. First of all, we got major overhead resistance. Major overhead resistance, like just above. I made my trend lines a little thicker than normal, which is kind of cool. I mean, it's the thing of it is that whenever I draw trend lines, they're never going to be, perfect to the pixel usually. But when you get one like this that has multiple sort of touches, so everybody's excited now that this trend line's been broken, and I should have put the 200-day moving average on here. I guess I could. Let's see. Oh, let's see. Moving average, simple. We'll just put a 200 on here. There we go. 200. Because, so many people put importance into a 200-day moving average. As you can see, there's been plenty of forays above the 200-day moving average that were temporary, and this could be the same, but it seems like the animal spirits are running rampant again on Wall Street, and quite frankly, at this same level that the market's at now, on the way down, when the market was going down, 4,100, was a nasty sell-off. For 4,800 to 4,100, people were freaking out, right? The market was tanking when it hit 4100 on the downside. And so now that it's right at the resistance of 4100 after a rally, it seems like everyone's acting like we're a couple of little rallies away from all-time highs. And so it's just funny how the sentiment sort of flows with put a weekly chart up here. The sentiment ebbs and flows with the price action, right? So when the market rallies, especially when you get like, what is this, 4 week rally. The market rallies over 4 weeks all the way back to where it came from after it dipped, and everybody gets all excited and acts like it's just a straight shot to new all-time highs, which quite frankly it's not. So here's the interesting thing. Since today is February 1st, we can go back and we can look at the monthly chart. And of course, the monthly chart, the trend line gets a little bit skewed, but let me just move this line for a minute. Well, actually, yeah, let me move it around. Look at look at the close back here in April and May. Whoops, I didn't mean to do that. I'll move this for a minute. Look at this close right here, April and May, right? So April, big down month, closed near the lows, and then May, it opened right there, kind of was all over the map and closed right there. Look at the July close, the July high right there. Look at the high of August. So anyway, let me put this line like basically right here. And you can see that to me, and let me figure out what that level is roughly. It's probably about 41.25, say 41.30. It depends. I got a pretty thick line there. So 41.30, say. But anyway, what I'm thinking is, and look how many months this is, 2, 4, 6, 8, 10, all the way back to here, right? So that's a pretty big level right there, and I'm gonna say that it's a pretty significant area of overhead resistance. So 4100 on the daily chart, kind of resistance, and I mean, quite frankly, I'm looking at the S&P here at 4067. It's very close. It's like it's one rally away from being at 4100. But I think that there's a ton of overhead resistance directly overhead, and especially looking at the monthly chart, it's just interesting because you can see those monthly closes just above 4100 and these highs and lows. And so, for it just to plow right through that seems like a long shot. I mean, it seems like a tough call for it to just plow right through that. So, the other thing to note on the monthly chart is, since the market peak, the market has tended to have these down months, up months, right? So, big down month, then an up month, and then, of course, that weird sort of thing. But you get these down months, up months, and so, especially like November and December. Anyway, rather than the market, well, I mean, anything can happen, obviously, and I honestly don't have a real good read on this whole thing from right here. So, it would seem unusual to me. Now, of course, the market could potentially start the month by continuing the rally up, but maybe you get something like this. Um, Maybe you get something like like this, but it won't surprise me. It won't surprise me to see a fold over here. Of course, I could be totally wrong. I mean, this could be. I've seen I've seen people out there posting charts that basically say that this is just a big giant sort of, there's the weekly chart, big sort of bull flag, right? I mean, you could theoretically look at this and say, well, this is in the big scheme of things. And it's interesting how the 200, this is a weekly chart, the 200-week moving average actually kind of comes into play. But yeah, there's a case to be made for a rally from here, even on that weekly chart. But the thing of it is that with all these rate hikes, they haven't really filtered, in my opinion anyway, the rate hikes haven't filtered through the economy yet. Let me see if I can fix this trend line. They say that it takes about 6 months for the rate hike. Well, yeah, it takes about 6 months before rate adjustments, I should say, filter all the way through the economy, and the succession of rate hikes that they've already put in place, and plus, today's, it just seems like the market, well, the market itself, when I look at it, I mean, has just made it back to, levels where that looked really nasty on the downside, and it's just because we've had a rally for 4 weeks now that everybody seems all excited and the animal spirits are back and that. But when you look at the chart, obviously it's not that big of a deal, right? And so we've seen plenty of false rallies last year. Earnings, I suppose, earnings are a mixed bag, right? And the thing that's really getting me here is all these companies that are warning about, well, not what warning, some of them are warning, but I think everyone was excited about Snap last night, and I mean, look at, this is just sort of typical, right? I mean, they talked a lot about Snap on CNBC, so some of these stocks probably should have never rallied as high as they did. Look at that. That's just crazy. And look at where it is now. And now that it's so low, these percentages are huge, right? I mean, the percentage moves on some of these speculative lower price Nasdaq stocks are insane. But so anyway, it's going to be interesting to see how the market reacts to. Take a look at the cues here. See how the market reacts to the Fed announcement today. And more interestingly, it's going to be interesting to hear what Powell says. This whole soft landing, hard landing thing, and then you get a lot of people, a lot of guys on CNBC or article writers that I read talking about, oh, we're probably going to have a mild recession. I mean, what is a mild recession? It's funny. So many companies are laying off. That's another sort of recent phenomena here, is like every single company, who's who, has decided that they're going to cut back on employees and lay off employees, and then their stock gets a big pop from it. So that's kind of odd, but the employment numbers are strong, but all these people that are getting laid off, I mean, thousands and thousands and thousands. I mean, if you search for, I talked about this last week, if you search for, job cuts or layoffs or whatever, you just can't even believe the news that comes up. So that's the new thing now, is everybody's trimming back on employees, and which makes you wonder why they hired them in the first place, right? I mean, if they're trimming the fat or whatever. And of course, the pandemic threw everything off. It made people think that certain trends. Oh, and by the way, the pandemic is going to officially be over. I believe it's in May. Like, there's a certain date in May that they've decided that the pandemic's going to officially be over that day, which is kind of funny. Yeah, I wanted to look at. Oh, so here's a poster child for the pandemic excess, right? The stock should have never, definitely, the stock should have never had that insane run up to begin with. And so, what's a fair value on something like this? Geez, I don't know. It's hard to really say. I guess fair value now is what people are willing to pay for it, but yeah, this is like the whole .com implosion all over again, to be honest with you. And of course, I like to look at ARK to get an idea of, and ARK's had at the beginning of the year, January is always an interesting month because we flip over the calendar and it seems like most Januaries, the market likes to, I guess institutions, fund managers, whatever, deploy a bunch of capital or whatever. I mean, things were extremely oversold, and so January is a good month to, to sort of roll the dice. There's a couple interesting things about this ARK here. Is in the very near term, I mean, the very short term. Of course, a lot's going to depend on how the market reacts to the Fed today, but this could probably, some of these really beaten down tech stocks, there's probably shorts that could cover. Every time the market has a big rally, especially like the end of the day yesterday, you hear about short covering, short covering. So I don't pay that much attention to the different indicators as far as how the put call ratio and the short interest and all that kind of stuff, but it is something interesting to follow because it's a different dynamic. I mean, the market doesn't just consist of buyers and sellers. You throw shorts into the mix, and that adds a little bit of a different dynamic to it. So, um, and so yeah, you can get short squeezes, right? I think we've seen a lot of that. I think that from time to time, a lot of, and especially towards the end of the day in the session, when you see the market, when it sort of starts rallying and breaking through certain resistance levels, then I think you get sort of you get a compounding effect where shorts have to start covering, and then more longs pile on, and so fundamentals it's interesting because the macro picture and the fundamentals and all that would basically, and I see this all the time. I mean, I read these articles, and there's a lot of really smart professional guys that have been around forever that are basically predicting a lot of gloom and doom based on the macro picture and scenario. And in the very short term, obviously in the short term they can be proven wrong, but you got to kind of pay attention to them. Pay attention to them because when they look at that bigger picture stuff, so it becomes a battle between sort of short term buying and selling and technicals and all that, as opposed to, and I suppose everything's going to boil down to, whether we get a soft landing, where the terminal rate is, what happens to home prices. That's another big deal, is the whole 2008 crisis was caused by falling home prices. The thing about home prices and just the whole way that the system is set up is that everything works great when home prices are rising, but when home prices are falling, then that's a big deal because it affects everything. And so I'm sure you've seen these things where, a year ago when interest rates were only, 3% or whatever, the median home price, you could buy the median home and your payment was only $1,300. Now that same payment's $2,400. So that's like a scale. When interest rates go up, home prices have to come down, and so they got kind of the housing bubble, right? I mean, you'd see these statistics about the rise in average home prices in different areas. It was nuts, and so that's all of this is. I'm not going to say it's all the Fed's fault, but it's mostly the Fed's fault. But it's also the it's also on the fiscal side, it's the government's fault for, trillions and trillions of spending. Every time you turn around, they're talking about spending, billions of dollars on this and billions on that. And what? They've passed like multiple, multi-trillion dollar spending bills. So the whole thing's out of control. It really is. So when the government's out there spending trillions of dollars they don't have, right? I mean, that's definitely a contributing factor towards inflation. And of course, it's the same thing we've been talking about for a decade, and I mean, it's just manifesting slower than usual. I mean, the federal debt just keeps going up and up and up, right? We just crossed $31 trillion dollars, and with rising interest rates now, the interest payment on that is going to consume, a significant portion of the budget, and the whole thing's just out of control, right? Government spending has been out of control as long as I can remember, and it just keeps getting worse, right? And the other thing, speaking of macro stuff, the other thing is that, the stock market itself has had like what, 40 years of declining interest rates, something like that. I mean, interest rates have been coming down since like probably longer now, since the 70s, right? Since you remember, parents or grandparents talking about paying 15% interest rate on their first home or whatever, and people bank CDs paying 15% whatever. So interest rates have been coming down for a generation, and then obviously they bottomed out at zero and stayed there for a long time. And if the big picture is that we're looking at the next generation of higher interest rates, then who knows? But and of course, the typical Fed playbook is that anytime that there's any sort of a crisis, the Fed slashes interest rates and creates a few trillion dollars out of thin air, which is probably what stoked all that inflation to begin with. So it's a mess. I mean, the whole thing is a mess, and quite frankly, I don't know. When you look at the numbers, you just wonder how it can continue. But then you look at Japan, and somehow or other, they did everything wrong, and they're still, they're still theoretically surviving. And then there's the whole demographics thing, which I'm not going to get into. But the main thing about today is, and I think I talked about this yesterday. Let's see, I could draw another trend line on here. There's this. Whoop. There we go. There's this, and so we kind of got, extend that out a little bit. There's an uptrend line. We've broken the downtrend line. So this is what I was going to say. This is kind of no man's land right here. This little upside down triangle. So the market itself is kind of in no man's land. If it breaks a little bit higher, as you recall, the major resistance, 4100 is kind of short-term resistance based on these highs from last December, but the real resistance, the one we looked at on the monthly chart, is a little bit higher. It's up here. So I'm kind of going back to these lows, these highs right here, especially this consolidation area. So there you go. Market's still kind of in no man's land. It could pull back, touch this trend line, bounce into this little area. So I have to say that the market is more constructive than it would seem the bigger picture would make it out to. So who knows? Who knows? But these are kind of, these are the trend lines I'm watching. This particular trend line here is very important, and we'll just have to see what happens. We'll have to see how the market reacts. And of course, the main thing to look at will probably be the end of the week. So at the end of the week, typically you're going to see some weird reactions intraday. The market, yeah, when they announce like 25 or 50, the market's going to go haywire in one direction or the other when they parse like the Fed language. And then, of course, when Powell gets up and starts answering questions, well, then that sets the tone for the rest of, the session. And it hangs. He can say a couple of things and answer a couple of questions that make the market, drop, and then he can say something else that makes it go right back up. So it's going to be interesting and fun to listen to. But usually on these Fed announcements, especially where we are right now in the rate hike cycle, I think that I think that allowing a couple days for the market to digest what was said. Um, so at the end of the week on Friday, we'll see where this thing lands. But um, the short term reaction may be. I think everybody. The funny thing is that everybody at this point, I think, expects Powell to throw cold water on the rally, right? And so it wouldn't surprise me to see the opposite reaction, just from whatever. But it's going to be hard to say. So we'll see what shakes out, and we'll see what everything looks like on Friday at the close. And I will see you back here next week, same time, same place.